$1.6 billion of client money simply vanished. This financial catastrophe engulfed MF Global in 2011, a brokerage firm with over 200 years of history. Known for futures and commodities trading, the company faced a monumental crisis when $1.6 billion in customer funds, legally segregated, disappeared without a trace. These sacred funds were meant to be untouchable, a bedrock of investor trust. Money was improperly rehypothecated and diverted to cover massive proprietary trading losses from risky European sovereign debt bets. The shortfall revelation sent shockwaves across the financial world, triggering urgent regulatory response and widespread panic among 175,000 clients. The firm's swift collapse occurred on October 31, 2011, marking one of the 10 largest U.S. bankruptcies with $41 billion in assets against $39 billion in liabilities. Federal regulators, including the Commodity Futures Trading Commission, CFTC, and the Securities Investor Protection Corporation, SIPC, launched investigations to unravel how internal controls failed, allowing a colossal breach. John Corzine, former New Jersey governor and then CEO, faced scrutiny regarding his aggressive trading strategies and management decisions. Recovery of missing customer funds commenced at once, an effort by SIPC and court-appointed trustees. Initial distributions were agonizingly slow and partial, leaving countless clients, including farmers, small businesses, and pension funds, in severe financial distress for months and years. Through legal proceedings and asset liquidation, 93% of segregated funds were located and returned. This event highlighted severe systemic deficiencies in financial oversight and the urgent need for stronger customer asset protections within complex derivatives and futures markets. New stringent regulations and robust enforcement measures enhanced transparency, ensuring such a breach could never be repeated. The MF Global saga remains a cautionary tale of perils from unchecked risk-taking and the critical importance of robust financial safeguards for every dollar entrusted to brokers. Impact stretched beyond individual accounts, affecting global market confidence and leading to reevaluation of risk management practices throughout finance. Thousands of clients relying on trading accounts for daily cash flow experienced unprecedented disruptions and hardship. Legal battles were extensive, involving multiple jurisdictions, countless investigative hours by federal agencies, reconstructing transactions leading to the $1.6 billion shortfall. The sheer scale of the financial hole demanded extraordinary efforts from liquidators, regulators, and legal professionals to reconcile billions in accounts. Implications for regulatory bodies prompted redoubled efforts to enhance oversight and implement more stringent auditing for all institutions handling client funds. Lessons from this 2011 collapse shape current financial regulations, emphasizing client money must always remain absolutely separate, sacred, and truly untouchable. The audacity and scale of the $1.6 billion disappearance continues to resonate powerfully as an unforgettable cautionary tale for all global financial market participants. Millions upon millions vanished instantly. MF Global became a name synonymous with financial betrayal, a truly devastating blow for 175,000 clients. This 2011 catastrophe, involving $1.6 billion of segregated customer funds, prompted a swift and severe response from global financial watchdogs. The Commodity Futures Trading Commission, CFTC, moved quickly to implement new rules bolstering customer protection and to prevent such a colossal breach from happening ever again. Rule changes mandated stricter segregation of customer funds, ensuring these assets were absolutely separate from a firm's own capital. Brokerage firms now had to hold customer money in a dedicated customer segregated account at an independent third-party bank and not within their operating accounts. This crucial step aimed to eliminate misuse of customer funds for proprietary trading purposes or to cover institutional losses. Regulators also increased auditing frequency and intensity, requiring more detailed financial reporting from all futures commission merchants, FCMs. Enhanced oversight meant regulators had a clearer real-time picture of a firm's financial health and its detailed client asset handling. John Corzine, the former CEO, faced intense scrutiny regarding his aggressive bets on European sovereign debt, which ultimately led to the staggering $41 billion bankruptcy of the firm against $39 billion liabilities. The fallout spurred the financial industry to reevaluate its entire risk management framework. Firms implemented more robust internal controls and stronger compliance departments to monitor trading activities and financial flows. Employee training on ethical conduct and regulatory compliance was significantly ramped up across the sector. The Securities Investor Protection Corporation (SIPC) and appointed trustees worked tirelessly to recover the missing funds, a process that stretched over many months and years. While 93% of the $1.6 billion was eventually returned, the financial and emotional toll on farmers, small businesses, and pension funds was immense. Many faced severe liquidity issues and operational disruptions for extended periods, highlighting vulnerability of even well-established financial systems. The MF global collapse served as a stark reminder of perils from unchecked risk-taking and the absolute necessity of rigorous regulatory oversight. It underscored that client money must always be treated as sacred and untouchable, a fundamental principle of trust in financial markets. The reforms introduced post-2011 aim to rebuild that trust and instill greater confidence among investors. New guidelines emphasize transparency, requiring firms to disclose more about their financial positions and risk exposures. The global financial community learned a painful lesson that even centuries-old institutions are not immune to catastrophic failure when internal controls are weak and risk appetites are excessive. The legacy of MF Global is a permanent shift towards a more vigilant and protective regulatory environment, ensuring future generations of investors will have their funds safeguarded more effectively than was the case in 2011, when $1.6 billion simply disappeared from plain sight. Billions simply vanished into thin air. MF Global's sudden collapse in 2011 shocked the financial world as $1.6 billion of segregated customer funds inexplicably disappeared. This devastating event left 75,000 clients, including farmers, small businesses, and pension funds, facing financial ruin and profound emotional distress. Former Chief Executive John Corzine's aggressive high-risk wagers on European sovereign debt catalyzed the firm's colossal $41 billion bankruptcy against $39 billion in liabilities. The Commodity Futures Trading Commission, CFTC, responded with urgent comprehensive reforms to prevent such a betrayal. New rules mandated stricter segregation of customer funds, ensuring these assets were kept separate from a firm's own capital. Brokerage firms now held customer money in dedicated customer segregated accounts at independent third-party banks, not operating accounts, eliminating misuse potential or covering institutional losses. Regulators increased auditing frequency and intensity, requiring detailed financial reporting from all futures commission merchants. This enhanced oversight provided regulators a clearer real-time picture of a firm's financial health and client asset handling. The financial industry reevaluated its risk management framework. Firms implemented robust internal controls and stronger compliance departments to monitor trading activities and financial flows. Employee training on ethical conduct and regulatory compliance ramped up across the sector. The Securities Investor Protection Corporation (SIPC), alongside appointed trustees, worked tirelessly over many months and years to recover missing funds. While 93% of the $1.6 billion was eventually returned, the financial and emotional toll endured by those affected was immense, causing severe liquidity issues and operational disruptions for extended periods. The MF Global collapse served as an unequivocal reminder of perils with unchecked risk-taking and highlighted the absolute necessity of rigorous regulatory oversight. It firmly underscored that client money must always be treated as sacred and utterly untouchable, a fundamental principle of trust for healthy financial markets. Reforms post-2011 aim to rebuild that shattered trust and instill greater confidence among investors. New guidelines emphasized profound transparency, requiring firms to disclose more about their financial positions and inherent risk exposures. The global financial community learned a painful, unforgettable lesson that even centuries-old institutions are not immune to catastrophic failure when internal controls are weak and risk appetites become excessively aggressive. The enduring legacy of MF Global is a permanent shift towards a more vigilant, protective regulatory environment, ensuring future investors will have funds safeguarded more effectively than was tragically the case in 2011, when $1.6 billion simply disappeared from plain sight.